So you found a company that you want to invest in, but how do you determine the appropriate size of the investment for your portfolio? That's the question that I'm going to answer in this video. So guys, as you smash that like button, let me run the intro. What's up guys, and welcome back to the channel. And this is the Q&A series where I try and answer a question that you guys have been asking in the comments. And today's question is a question that gets asked often, which is how do you determine the appropriate size of an investment in a particular company? And the answer to this is it's a bit of an art and a science, but I'll try and walk you guys through sort of the way that I think about it. So when I was thinking about portfolio diversification, I wanted to write my thoughts out in at least like these 4 points that came out. And as time goes on, I'll probably refine this. But the first thing is when it comes to my risk management strategy, that's kind of the way I think about portfolio diversification. It is ultimately a risk management strategy. And what I do is I use portfolio diversification in conjunction with a large margin of safety and thorough analysis of the company to reduce portfolio risk. So I'm doing 3 things. The first thing is diversifying the portfolio. The second thing is making sure that I get a large margin of safety on the security that I buy. And the third is, of course, doing a thorough analysis. In fact, I'd probably go backwards. You start with a thorough analysis, then you only purchase it with a large margin of safety, and then you limit the size of which you're going to purchase it into your portfolio. But the question is, how do you decide what that size is? It's this last part. We all know how to do the analysis. We all know what a large margin of safety is. How do we size it? And here's where I would say that I respectfully disagree with Charlie Munger. Charlie Munger will tell you that, hey, often in your life, you're not going to find a compelling or exceptional opportunity that often. And I agree with him. But the reason why I disagree with him is that, even after doing this for, I guess, more than a decade, I'm getting on a couple of decades now, I still feel as though I'm not experienced enough to really know for sure if I'm looking at an investment opportunity that's truly exceptional and life-changing. I always sort of like second guess myself a little bit. And that just might be a personal thing. But, I don't know how many people who invest in the markets today can say, hey, you know what, this particular opportunity, this is the Costco, or this is the Coca-Cola, or this is the Gillette, et cetera, et cetera. It's very difficult to catch those types of opportunities. Yeah, you see them, but things could always go wrong, et cetera, et cetera. I haven't really had the strongest level of confidence with loading up the portfolio. So, I'll say that I respectfully disagree with him here, but, there's no right or wrong answer. Like, you could feel as though you like the position enough where you want to build up a 30 or 40% position in your portfolio with that name. I think as time goes on, what ends up happening is you make like a major bet in something. Maybe it's like 15% of your portfolio, and then it just grows exceptionally. It just becomes a substantial amount of your portfolio as well. But in terms of like capital allocation, you don't want to be throwing 70% of your portfolio into one position. At least that's how I think about it. You guys might think about it differently, and there's no right or wrong answers there, but I would just say I respectfully disagree with Munger with taking huge shots at only 2 or 3 names. But you guys let me know what you think about that. And so that goes back to my point where I try to max a position between 5 and 10% depending on what it is. And so my portfolio at any given time is comprised of between 10 and 20 positions. And what I do stress is just because I like 10 and 20 positions, it doesn't mean that I like a large amount of diversification. I would say do not over diversify. Do what's right for you. And I think as time goes on, you'll get a good idea of what works best for you. And so, personally, I'm constantly doing research and searching for securities so I can personally handle a 20 position portfolio, or like an up to 20 position portfolio. So overall, what I'm trying to tell you guys is that, diversification really depends on your level of confidence for the securities and the time that you have to invest in your portfolio. Some of you guys may not have the time to, own 20 names in your portfolio and then constantly do research on them, because one of the tenets of portfolio diversification is the more names that you have in your portfolio, the more work you have to do to keep up with the securities that you own. At the end of the day, you have to look at yourself as a business owner. You have to understand what's going on with the business. Don't look at the share price. As far as you're concerned, when you buy the security, the share price, the stock market turns off. Now it's time for you to start learning as much as you can more about the business than you did just in your original research. Keep up with the comings and goings. try to assess management's reaction to different situations, etc. Now, I'm going to give you guys a shortcut on how you can stay in touch with your companies or stay up to date with the companies that you invest in. So this is the website of Meta, and you can see that on most investor relations websites, you can click into something that's called email alerts. And what you can do is you can get access to all the news, all the SEC filings, all the annual reports. Sometimes they'll give you access to all the presentations that they put out, etc. So you can be completely up to date that as soon as they issue a press release, it gets sent to your email. So you will be completely up to date about all of the comings and goings, all the news, all the disclosures, everything as it relates to the companies that you're tracking. So at the very minimum, you should be signing up to the investor news of all the companies that are in your portfolio. And the last thing that I do is when it comes to position sizing, what I'll do is I'll take a look at how much of a discount to its intrinsic value that particular position has. And if it's got a substantial discount, like it's trading at much lower than 50% of what I think the intrinsic value is, that might be a reason why I increase the concentration of that particular position. And so I'll show you something from the past where I actually did increase the concentration. So here is an old copy of the tracker, and you can see at the time Alibaba was one of the cheapest companies on the tracker. It was trading at what I felt was 40% of its intrinsic value. It's trading at much higher than that today. However, you know, when it got to even lower than this, it actually got to a point where it was trading at 30% of its intrinsic value, even lower. And at that time, I had held it around 5% of my portfolio, and then when it went to around 30%, I actually doubled it to 10%. So that was one of those situations where it was a very exceptional time, and I substantially increased the sizing of the portfolio. Now, you would ask, why wouldn't I increase it to more, like 30% or something? Because I felt like there was some risks of investing in China, which I covered in a lot of detail on this channel. And so I felt that 10% was appropriate for my portfolio. And then, you know, at that same time, you know, H&R Block was trading at 65% of its intrinsic value. So, you know, if I was purchasing shares in H&R Block and I was comparing it to Alibaba, I'd probably size this lower, size Microsoft a little bit lower, maybe. And then, of course, AMD, which was trading at approximately its intrinsic value. If I was buying that, I'd size that a little bit lower as well. So, you know, I use a combination of the story and the valuation in the tracker to determine the position size. And so what I would say is that there is a bit of an art and a science to position sizes. Now, if you don't have a tracker, I encourage you guys to build one. However, if you just want access to my tracker that I provide, which I don't expect you or don't want you guys, or I don't encourage you guys to make investment decisions off of this, is just for you to get access to my research in an effort to help you with doing your own research. But you can get access to all of my models and all of my research at that lower tier of the Patreon. And you know what? I love doing this. I would have a tracker even if I didn't have the YouTube channel. In fact, I had a tracker for many years. I just did it on Excel. And so now I love the fact that I can share it with you guys. And so if you guys are interested, you can get to that at the lower tier of the Patreons. You can find the link in the description below. Now, the other thing is, guys, keep hitting me up with your questions, because as time goes on, I'm going to continue to release more Q&A videos to try and answer all of your questions in as much depth as I can. Now, if you've missed any of the previous Q&A videos, you can get access to the latest one right here.